Money News Ultimate Wealth Reporter Mark Chandler, Global Head of Currency Strategy at Brown Brothers Harriman, to get you set up for the trading day. Sean, I want to start with you and what's happening with precious metals, because I know that that's basically your wheelhouse here. Gold is already down 24% this year. I think it was off by about 7% last week alone. What happens this week?
I think gold goes down a bit further, and the reason being is because you had gold go in a sideways range for about a year and a half, formed a rectangular pattern on the chart. It broke that around 2015, 50.
Mark Chandler, Global Head of Currency Strategy at Brown Brothers Harriman, to get you set up for the trading day. Sean, I want to start with you and what's happening with precious metals, because I know that that's basically your wheelhouse here. Gold is already down 24% this year. I think it was off by about 7% last week alone. What happens this week?
I think gold goes down a bit further, and the reason being is because you had gold go in a sideways range for about a year and a half, formed a rectangular pattern on the chart. It broke that around 2015, 50, and so there's a minimum price target that takes gold down to about 1240, and so anywhere in that range really is the starting point where somebody would want to start investing in gold again, but not a moment sooner, because these things can actually shoot further past that. Then once the dust settles and things stabilize, I believe we'll see gold eventually head back to the 1600 level.
Apart from the price dropping though, Sean, what's the investment case for gold at this stage? And there's no inflation out there right now, and certainly we're not seeing enough physical buying to be able to support gold at these prices.
Yeah, in the near term, I think you've got a near-term, long-term catalyst. The near-term catalyst is, I believe, you're going to see stocks continue to correct further. I think you'll see Dow go to 14,000, S&P 500 go to 1,500. And so I think a lot of money might get scared and go into to gold there. But also, you're starting to see the dollar deteriorate. The dollar had gone up for 2 years. It reached
Hang on, the dollar deteriorates? The dollar deteriorates?
Yeah, the dollar's gone up for the last 4 weeks in a row, except for the latter part of last week. But yeah, and it formed a new lower low in the month of June, and so it's broken the near-term uptrend line. It's reached the top of a long-term downtrend line. It's been in effect since 2005, and so I think we could actually see the dollar roll over from here. If the dollar goes lower, then we see a lot of support for both gold and silver.
The dollar rolling over. What do you reckon, Mark?
Yeah, I don't know where it's coming from. Here's my take of things. There's three different forces at work here in the markets. First, of course, is the tapering talk by the Federal Reserve. Secondly, is the Japanese continue to sell foreign assets. Already this year, they've sold about $125 billion of foreign assets. And the third factor, encouraging this global unwind, is the fact that there's a liquidity squeeze in China, which has also been subject to a big carry trade as well. So I see the dollar as being the big winner here. I think the dollar's on its way to new highs for the year against the euro, Swiss franc, as well as the British pound.
I'm just trying to still understand the timing of this. That's all I care about. All I care about is what's going to happen this summer, meaning is this only going to get worse? Is it going to get better, and when?
What's going to get worse? The market drop?
The market drop.
The last 4 years, we've had 5 to 10% corrections every summer, although I have to say, this time it feels a little weird.
It's got to be different.
Because you've got China with now these issues going on. You've got the QE coming off the table. It does feel a little different than it did previously.
I want to know if this is cyclical or it's a little secular.
I think this is the end of a 4-year of trade. And the 4-year trade has been short the dollar, long emerging markets, short the dollar, long commodities, short the dollar, long gold. I think this is a multi-year trade that's being unwound here. I don't think it's the same thing as last summer. I think this is a new world because we're talking about the end of the QE in the U.S. Even if it's not yet, it's going to be coming perhaps in the next 6 to 9 months.
So as the U.S. dollar strengthens in that scenario, can stocks also rise off?
Well, I think this is the unwinding of the carry trade.
Agreed. It's the unwinding of the carry trade, and stocks can rise because we have a manufacturing renaissance. We're heading toward energy independence. You've got the federal budget deficit falling, and so the debt to GDP ratio is not going up like people thought. The U.S. is doing some good things despite the concerns in the near term, which I'm not going to minimize.
Mm-hmm.
I wouldn't disagree that those things are going on. I think that the conviction about them doesn't arrive by invitation. So in other words, these rotations happen, but they can be messy. And I feel like one of the reasons that we reacted so strongly to Bernanke is if he's sort of signaling we've done all we can do, or we might by mid next year, then and we still have an economy that's not performing the way we feel like it should be, and we still don't see the reacceleration in the second half, we don't have another story to agree.
Here's the thing. I think there's something bigger going on as well. Bernanke also talked about upgrading the U.S. economic assessment. The downside risks have been reduced. For example, 1.7 million American households are now not in negative equity in their houses because, as we'll find out tomorrow as well with the Case-Shiller house price index, housing prices are up 10% in the past year. And that's important stuff.
You know, here on television, though, we all have to admit, and I think our viewers and listeners know this, right? You want to sound as smart as you can. You want to say these sort of complex things and make people think you're really dialed in. All I care about is, will the American consumer spend more or less money? Will businesses invest more or less money? Because I hate to be so doggone Graham and Dodd boring, but a stock is just earnings. It's supposed to be earnings, right, Bob? I mean, and we're lost in all this other stuff.
No, but it's
getting on. ISM, durable goods, and Billy Fed are all down from last year. The economy seems to be slowing a bit. That, to me, seems to be the biggest.
I don't disagree, and Mike's already brought that up. Look, the last 18 months it's been mostly PEs, not earnings. And if PEs are done, and PEs are probably done if the Fed's done, then the next thing that we're done. Finished.
Got multiple expansion.
Multiple expansion we have enjoyed as the Fed.
Over. Now you're calling. You need to see
and now we need earnings, which means we need an economy, and then we need some revenues, and the jury's out on that, and that's why this might take some time.
So if we take this one step further, if the Fed had stopped at the end of QE2 and not gone ahead with QE3, where do you think the stock market would be today based on economic fundamentals and earnings alone?
Not where it is. It'd be lower than where it is, because the last leg,
lower?
Well, no, it's a lot lower, but the last leg was about the financial issues. It was still about the big black hole. QE1, QE2, QE3, we have the risk of a black hole, and that risk in the Fed's mind, I think legitimately, is lessening. And therefore, the PE run that has occurred as people have recognized the big black hole isn't going to happen is in its waning days, and we need to move to E.
Mike?
I agree. No, the role was to wrestle volatility to the ground, and that actually allowed you to have all these riskier assets do better. And so maybe the trick is, just at the moment we thought tail risk was gone, something comes back. I don't think it's the big black hole like Bob thought.
I like that analogy. Central bank MMA, Bernanke versus Bullard, no holds barred cage match. Who wins?
By the way, I actually think the interesting thing about the Bullard,
Bernanke will always win.
the interesting thing
Actually, physically
about 2%.
Tough to fit.
Actually, Brian. What language do you speak? Australian?
The interesting thing about 2%, one hawk, one dove is, you remember we said with the Hindenburg omen? You know, you have too many new highs and new lows at the same time. There's sort of a dissonance in there in the message, and I think that's interesting, and it tells you why the market's confused.
Okay, well, let's get back to Sean and Mark and get the playbook for this week. Give us your best trade, Mark, and it doesn't have to be dollars, it doesn't have to be yen. You can go a little bit out of the box. For example, what's the best trade, for example, for an emerging market currency this week?
You know, I think that we're best served by thinking that these trends that we were in place last week will continue this week, and that means a stronger dollar, not just against the major currencies, but against the emerging market currencies as well. This unwind is still in the relatively early stages. I still like the dollar for the next several months on the just a forward-looking basis.
And Sean, where do we go for gold this week? What levels are we looking at?
You know, the markets are so elevated, there's not a lot of areas of the market that are trading at a value. Right now, you've got a gold stock like Newmont Mining trading at single-digit PEs. It's trading a couple of bucks above its book value. It's got $1.5 billion of cash on its books, and it's got like a 4.7% dividend yield. So that would be my play.
Okay, a gold miner play. Thank you very much, Mark and Sean.